Good morning to everyone watching live here on BAM YouTube. Let me know in the comments where you are tuning in live from today. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. And on today's hot sheet, I will cover January retail sales, rising mortgage rates, and buyer motivation. Today is Wednesday, February 15th, 2023. I am Byron Lazine, and the hot sheet starts now. Thank you for joining me here today as I sit in my Naples studio. Happy to be here, but back on the road tomorrow. We'll be up in Orlando getting ready for our Chat GPT event, which is tomorrow from 10 to 1. So I'll be doing the hot sheet from there. There'll be a link below if you want to attend that virtual event, and I'll make an offer to everybody here on the hot sheet later in the show. Hit the thumbs up. It's the best way to support this show right now and get it in front of more people. Please consider sharing it with somebody who wants a 24-hour look back on our housing market. Okay, we had a release at 8:30 this morning. U.S. retail sales, they rose sharply in January. In any market, this would be very good news. In any normal market, seeing that U.S. retail sales rose 3% in January, which is a sharp rebound in the last 3 months. In fact, this is the first time since October we've been in the positives for retail sales. Okay, so job growth has accelerated. We've talked about that a bunch on the hot sheet. Inflation has cooled slightly to start the year. We obviously had some information yesterday that shows it's still a very bumpy road for inflation, but inflation, rising borrower costs, and uncertainty about the economy obviously have caused households to pull back in Q4 of last year. November and December were very low for retail sales. Okay, they were below expectations. They were in the negatives, and now we're actually the first number here in the positives for January. But unexpectedly strong jobs report in January and solid wage gains bode well for more recent consumer spending. Some of them think economic growth could be picking up. Okay, so most of the time we'd say, great, economic growth's picking up. We're going to have a good year here in our economy. We're going to have economic growth. We're going to have GDP growth. But this is resisting what the Fed wants to make their job easier, which is a recession. If we have economic growth, right, if it's matching up right now, January, this is a huge contributor to that GDP number for Q1, right? We had 2.9% up GDP in Q4. We could be trending towards a positive GDP number in Q1. But remember, the Fed wants a positive number, but they just want slightly positive. They want like 0.5% or 1% GDP growth. They don't want to put up another 3% on Q1. Okay. And so the expectation right now and what we're seeing is that we might have a substantial number as it relates to GDP growth in Q1. Again, that's always normally great news. But when we're trying to fight inflation, when the Fed wants their job to be a little bit easier, it might not be the best news for what type of action they take in March. What are they going to do in the FOMC meeting when they meet here in just a couple of weeks and decide on the next rate hike? We just had a 25 basis point hike. As I said yesterday, I believe they're probably looking at a 50 basis point hike, even though a lot of people are like, okay, we're down to 25. We're just kind of going to normalize there and maybe just have a couple more 25 increases. It looks like we could have a 50 increase. It's more likely than not, I would say, based off of the news here in the last week and a half, based off of this job report that the Wall Street Journal that I was just reading from is referencing. Okay, so but overall, surprisingly here, consumers are in pretty decent shape, says Joel Naroff, president of Naroff Economics LLC. When people are comfortable in their job situation, that translates into consumer spending. We added 500,000 jobs. A lot of people are pretty comfortable that they're not going to get laid off in many different industries, and they're going to go ahead and spend. Economists surveyed by the Wall Street Journal estimated that retail sales rose 1.9% in January from the prior month after adjusting for typical seasonal patterns, following a 1.1% drop in December from November. Okay, so auto sales were up big in January, huge increase in auto sales. And we did see yesterday that prices on auto sales came down a touch. So while auto sales increased in January, prices did come down a touch. There was a little bit of a silver lining there. Timothy, this was interesting. Timothy Boyle, chief exec of winter apparel maker Columbia Sportswear, says his company is benefiting from people wearing more casual clothing in the office and at remote jobs. Talked about a wardrobe issue yesterday in real estate on the Real Word. You can go check that out if you're interested. That's up on BAM. Okay. Here's what's also interesting. And more information is going to come out later this month. The retail sales report is only a partial picture of spending, and it doesn't include many services such as travel, housing, and utilities. Okay, so the Commerce Department is going to release its monthly report, which includes more complete spending figures later this month. So this is one way to look at things. Normally, hey, 3% versus a 1.9% estimate that was surveyed is a good thing, right? If we exclude auto, we're up 2.3% versus a 0.9% estimate. So what happened in retail sales in January? Incredibly strong, beat estimates in a really significant way. Normal market, okay, normal economy. This is fantastic news. It means our economy is growing. While we're fighting inflation, maybe not so much. Maybe the Fed doesn't love that this is the first time since October we've been in the positives. Okay. Consumers, though, right now, I will note, have more than $1 trillion in savings in comparison to 2019. That number has dropped significantly in the last 12 months. It's going to continue to get kind of pecked away here by inflation in 2023. Consumer savings are going to be tested. 2019, they weren't that strong either. So let's take that into consideration. But consumers are in a much stronger position than they were in 2019 pre-pandemic. There's also this, I just have a couple notes here from this morning when they released this 8:30 information. There's this theme here that, okay, we've been talking recession for a whole year. We're going to have a soft landing in 2023. We talked about that at the beginning. Hey, some great news coming out. Maybe we're going to have a soft landing, shallow recession. And then now it's like, okay, maybe we're going to have a hard landing. Okay. Some of this information is contradicting a soft landing. And now there's people saying we're just going to have no landing. Consumers are strong. People are spending. The consensus from a lot of the economists say the Fed is not going to cooperate with no landing. They are going to have a landing. So it's either going to be soft or they're going to make it deliberately hard. This information here pushes against making that job easier in a recession. So we will have to see what comes of this. There's a bunch of information that's going to be coming out, obviously, this week and every week. So just keep staying tuned to the hot sheet to get that information at your fingertips. And by the way, tomorrow at your fingertips, before we move on to the next topic, you can have all the information you ever needed on ChatGPT. That's right. We have partnered with Chris Smith to bring you a 3-hour ChatGPT for real estate workshop. You're going to be able to learn what is ChatGPT if you've just been hearing about it and it's like the craze, how to write effective GPT-3 prompts, how to use GPT for your research, your image, your designs. We're going to go in detail on those 3 topics each hour during the 3-hour workshop. I'm going to be making sure Chris Smith stays organized, stays in alignment. Okay. And so I'll be taking questions from everybody that's in this exclusive workshop. We've got a BAM offer down below where you can get this for just $69. The normal ticket price is $99. You're going to have access to this. So if you can't watch the whole thing live, you'll have access to break it down and you will be able to ask live questions. ChatGPT workshop with myself and Chris Smith tomorrow, 10 to 1. I'll be doing the hot sheet from Orlando where we will be doing that workshop live. Okay. Also, right now in this economy, higher mortgage rates are becoming a reality. It seems like just yesterday we touched down at 5.99. I believe that any buyer that got locked in on that one particular Thursday just a couple weeks ago, 2 weeks exactly from tomorrow ago, are really feeling fortunate. We've been sitting in a 6.5% 30-year fixed mortgage rate environment since then. And we have an opinion piece from Connor Sen in the Bloomberg, who says higher mortgage rates is what the housing market needs right now. Okay. So he says home buyers are more resilient than expected. Okay. And so costs will have to rise again to choke off demand and bring inflation down to the Fed's target. So listen, let's first of all correct Connor a little bit here. Demand is still down 42% since this time last year. Okay. So that is a pretty significant. I think I have it handy here. I'll give you the exact number. I think it's 42%. On a year over year basis, purchase applications are down 42.6% year over year. Now, I've often said year over year is not a good indicator for a lot of things like inventory. But when we look at demand, okay, we're not in the same situation we were in last January in demand. The problem is we just have no good inventory on the market. All the good inventory is being sat on. It's either now going over to the renter nation segment of the market because investors are sitting on it and renting it and making sure those rents are a little bit lower than buying a house. And there's a lot of support behind that to make sure people don't grow their wealth, right? There's a lot of federal support. There's a lot of local support into making sure people just stay renters. So there's that. And then there's just regular homeowners like, I got a great house. I'm going to keep it. Maybe I'm going to keep it as a second house as opposed to put it on the market. So we don't have great inventory on the market. That's an issue right now that is being met with this lower demand. So I want to just make sure, correct him there, because these are the things that, consumers are certainly reading. We have far less demand than we did last year, but that demand is being met with low and really no good inventory in many markets. Okay. So the surprise here, January, is how strong the economy started off the year, particularly the housing market. It seemed to take off for buyers come flocking back. Okay. They've come flocking back at a 40% lower clip than last year. They've come flocking back in comparison to quarter four, where it was very quiet. Okay. I'll give them that. 2022 quarter four was very quiet. The 30-year mortgage rates eased at that particular time when we had our really low point right now of inventory. So we neared 6. We had that one day at 5.99 after reaching the 7.25 hike in October. So this is a great thing for affordability for a lot of buyers. Okay. Mortgage purchase applications, though, are rising again. All right. They're rising slightly. They're up 3%. Okay. So in the last week. So let's not get carried away here. Okay. We've spent a lot of time the last 2 weeks kind of tampering down how significant these mortgage application rises are. It's more about, what type of inventory is here. So the glut of existing homes we expected as the market slowed down never materialized. Right there, you hit it, right? We don't have great inventory here. We don't have this glut of homes coming onto the market. We know builders aren't building. We know what Goldman Sachs predictions are. We've talked about that a bunch. You can go look at some past hot sheets if you want to check out that. Okay, so here's where he gets into where his opinion is this interest rate needs to get up over 7%. Fed Chairman Jerome Powell talks about this housing reset to the extent the Fed's tweaking of interest rates is meant to keep balance to the market. The evidence so far in 2023 is that a rate of 6% is too low. Okay, the evidence so far in 2023 is the rate of 6% is too low. Let me know in the comments if you agree with that. Is 6% too low in your market? Do you see too much demand for the supply that you have, that 6% interest rates are too low? Or is it just enough to help affordability to create a normalized market? Love to know from you and your personal local market, because we know a lot of this stuff is localized. Okay, yeah, I just saw, not to divert again here, but I just saw a YouTube video from Reventure again, talking about Phoenix being up a couple 100% in inventory. They're still well below 2019 levels in Phoenix. If you're from Phoenix, let me know. What I'm seeing is they're still below 2019 inventory levels. They're getting closer to that mark. By the way, 2019 was a pretty normal market. So when you say inventory is up 200%, okay, okay, great. That's going to help affordability. And if we have a 6% interest rate, a lot more people are going to normally pull that price down to a level that the Fed's going to say, okay, I kind of like where things are going, as opposed to an unhealthy level. Okay, so to keep the economy from overheating, mortgage rates around 6.5 where they are right now, get closer to the mark. Okay, so he's going to argue here in this article that we need to get to 7%. Okay, I don't know. Do you believe we need to get to 7%? I believe that that's where we're heading. I can see certainly. I can assume that interest rates, given the last couple of months, we're going to hit 7%. Doesn't mean we're not going to get back into 5 at some point. There's a lot of uncertainty. There's a lot of volatility in this 30-year mortgage rate. Let's see what Logan has to say about the hotter inflation and will it send mortgage rates back over 7%. Logan Mohtashami, obviously from Housing Wire. So given that inflation, that CPI report that we discussed on Tuesday, yesterday, can mortgage rates go above the 2022 peak level of 7.37? Okay, so yesterday, the 10-year kind of bounced all around, right? It went up, it fell back down, and kind of ended the day at 3.753. We'll take a look at where it is exactly today. I can give you a hint. It's up again before we started this show. Okay, so what Logan is arguing here is that we need to really look at this bond market. We need to look at where the 10 year is going to go, and we need to continue to follow that closely because that's going to give us every indication of where the 30 year is going to fall. He talks about this inflation as it relates to housing, that even on yesterday's report, and we talked about this yesterday, that rental inflation is all kind of like coming later on down the pike. We're not going to really know the true story. 7% was the goal pre-COVID. It's inevitable. Yeah, I think it is inevitable once again that we're hit that. I'm in agreement with you there. That the inflation for housing is coming further down the pike. Okay, so we saw rents go up again in yesterday's number. Now, I've been talking a lot about, hey, we're going to start to see at some point those cool down. We're going to start to see that in the inflation reports, housing is going to make up less of it, but it hasn't hit us yet. So it's a lagging measurement that we're still waiting for that data to kind of catch up. Logan argued from his 2023 housing market forecast for 2023, the 10-year yield currently at 3.7. He believes this range for the year, this is his prediction, will be 3.2 to 4.25 as long as the economy stays firm. Okay, so he says if the economy gets weaker, especially in terms of the labor market breaking, which is for jobless claims rising above 323,000 and beyond, then we can get as low as 2.73 on the 10-year yield. That'd be a big drop from where we are today. Okay, and we haven't seen that job market get weaker yet. Okay, so with that 10-year yield range of 3.2 to 4.25, rates should be between 5.25 and 7.25. We're much closer to 7.25 sitting here at 6.6 and above today than we are at this 5.25 because we're much closer to the 4.25 on the 10-year. All right. This assumes that the spreads are wide and pricing for mortgages is still weak. However, if the spreads get better, we could see mortgage rates under 5%. I do not anticipate we will see a 10-year break under 3 anytime soon, and or a 30-year fix go under 5. I mean, we get into the 4s, we're off to the races in terms of demand in housing, because we did see, so to that Bloomberg opinion piece, we did see, and it was a seasonality, timing thing too here in January, we did see a lot of buyers react positively to that. We go to 4.99. We already know when it came to 6 that there is a level of pent-up demand. Yes, demand is down 40% from last year when it was at an all-time high, which drove inventory to the lowest level we've ever seen. But we do know that as these interest rates drop, there is enough pent-up demand. There are enough first-time homebuyers, starter homebuyers, millennial homebuyers that are just waiting. Okay, the two people that produce this show with me, our lead producer at BAM, video producer Bobby, and our senior editor, Vanessa, who writes so many of the great articles that you read on BAM, they're both in that camp, waiting to pounce and buy their first home. But they're on this show every single day. They're looking at this data, and a lot of it's very confusing, okay, for a buyer. And that's just the reality. And so if you're an agent, the discussion has got to come around, are you going to be here for sure buying right now, 7 to 10 years? Okay. I don't think 4 to 6 years being in the house is going to be enough if you're buying today in the first 6 months of 2023. Too much uncertainty. There's a lot of things that could pull this price down 10, 15% and take a few years to recover. We're not going to have a 40% drop and lose everything for those buyers that did buy in 2020. But if you buy today, you could be faced with 10, 15%. There are, I believe that we're going to be under 10% in 2023. There's just not enough sellers. There's not enough inventory to pull it down significantly. But there is enough volatility for me to be wrong on that. And any agent who isn't kind of guiding their buyers in that direction of like, here's the reality that we're faced with now. Here are the 2 or 3 things that could happen. And by the way, why are you buying, right? Is this shelter for the next 7 to 10 years? Great. Let's go find the perfect piece of shelter and a payment that fits into your budget. If it's an investment, we're going to have a whole different discussion. Okay. So what do we know about inflation? According to Logan, the growth rate is cooling from last year's peak. Yep, we know that the shelter inflation portion of housing will cool down over time. Okay, so that's what we keep talking about. We're waiting for that portion of housing to cool down in inflation. That's going to be a much better read for the Fed. It's widely known that CPI inflation lags a lot, and the most significant component of core inflation. So it's a very big deal. Okay, I want to get into his final thoughts as he wrapped this up. You can see here, this chart's down below in our daily download as well. The 12-month percentage change of the CPI selected categories, but not seasonally adjusted. So we had some other charts that were seasonally adjusted. This one's not. And you see here shelter included in what it's done to that number. So as shelter kind of those lagging measurements, especially the rental numbers, kind of pulled down, we should see this number start to cool off a bit. Okay. So let's just go with his summary here because I think it's important. Hopefully this explanation of the forecast for 2023, 10-year and inflation gives you a better understanding why he does not believe mortgage rates can rise above last year's peak, 7.37. Okay. He believes that as this data catches up, we're going to see a max 10-year yield of 4.25. He actually believes the 10-year is going to go lower from where it is today. So that would be good news for these mortgage rates. But now, here's what I thought was pretty important. One way mortgage rates could blow past 7.37. What does blow past mean, by the way? Is that 8%? Is that 8.5%? What does blow past mean? Okay, so one way mortgage rates could blow past 7.3% is if the economy starts to boom again. Well, what we just talked about on January retail sales signals a strong economy, signals somewhat of a boom for 1 month of data on retail sales, up 3% when the expectations were 1.9%. That would be a big number. Okay, so the economy starts to boom again. Supply doesn't grow. There's a lot of reasons for me to believe supply inventory is not going to grow this year. And wage growth, which has been cooling, reverses and explodes higher again. Okay, so that one I think is less likely. That wage growth is just going to completely explode. I think there's enough business operators that are taking a very conservative approach to their business in 2023. I don't see wage growth exploding in 2023. I know there's a lot of jobs openings out there, but I do think we're going to have more of a flattening like we've seen in the last month or two on wage growth. So 2 out of 3 I don't see happening, but I do see supply having a struggle to grow. And the economy is showing signs that while maybe you wouldn't call it a boom, it's very strong and consumers are pushing back. If rents and wages took off higher again, okay, so I don't think rents take off. I do think we're going to have data that shows us that rents are going to cool and wages took off higher again. And some new war created more of a supply shock and the labor market got even tighter. This would counter my discussion that the growth rate of inflation has peaked. However, so far, it doesn't look like anything I just talked about is happening. So give more time. And I do think what he's talking about, supply not growing substantially enough and economy being strong, could happen. But there you go. Those are the thoughts on the 7%. I think with that, to me, there's more than a likely chance than we sat in the beginning of January that we could see a 7% interest rate. We're almost touching on it now as we sit here, and we'll kind of recap where we're at up to the minute on the 30 fixed as we finish off the show. Before we do that, let's talk about what buyers are motivated by and what their motivations are right now. This is according to a Redfin report that we covered on BAM. You can get all the BAM articles at nowbam.com. Okay, so as mortgage rates did fall from that peak of 7.37, home prices have come down in some markets. I know not all, so let me know if prices are up or down. Just say up or down in the live chat in your market. Prices up or down right now, live chat. More sellers are returning to the market. That's very arguable in a lot of markets. I know, yes, I mentioned Phoenix. Yes, Las Vegas. There's more sellers entering, but there's many markets where they're not yet, and we'll hope to see that in March. Buyers signing up for a $3,000 mortgage payment can afford homes costing $60,000 more from that 7.37 peak. That's starting to shrink, though. Okay, Redfin, that is starting to shrink, and roughly 84 square feet larger than October 2022. Couple interesting things here. I'll go to the charts, and these are all available in the daily download below. Okay, the value of a home that a $3,000 monthly mortgage payment affords, I got to show it to you. Mortgage payment affords is highly dependent on mortgage rates. Okay, so if you see there in March 2021, $3,000 payment would get you a $940,000, almost $50,000 home. Okay, this is with 20% down, 30-year loan term. Right now we're sitting above 600,000. So big drop from March 2021, but an increase for sure from where we were late last year. Okay, where we were almost down to 550,000. So that's where they're getting that 60,000 from. Nice little bump up that will bring more buyers to the market. But as this interest rate is back up on the rise, this is going to push this back down. Okay, so what you're seeing here as you get updated data, if we stay around 6.6 where we're at today, or we get into 7%, that's going to push that number back down. Okay, so affordability still a real struggle for a lot of these buyers. And then the other interesting part is where are the trends? What are buyers looking for right now? What are they motivated to go and buy in this market? What type of house? The buyers that are in this market, the 42% less of buyers using a mortgage that are in this particular market here in 2023 compared to 2022, what are they buying? Well, in hot markets like Indianapolis, we talked about Indianapolis recently being one of the hottest markets. So it's a more competitive, more affordable market than other parts of the country. They're looking for smaller homes. They're looking for smaller homes in Cleveland. In Hartford, Connecticut, they're looking for 1,200 less square feet. That's the biggest number on this chart. Milwaukee, 900 less square feet. Buffalo. These are smaller cities. They're all very comparable to each other. You've got New Orleans on here. They're looking for less square feet. Overall in the U.S., they're looking for 140 less square feet. So while the trend was in San Francisco, they're looking for 166 less square feet. I don't know how much, lower you can go in San Francisco. Some of the shoeboxes people live in there. But what we're seeing in these competitive markets is that, okay, if there is low inventory, okay, you don't see Phoenix on this list. If there is low inventory, I'm at a more affordable market. Take San Francisco out of there, take Seattle out of there, which are on the bottom of this list. But I'm in Indianapolis, I'm in Cleveland, I'm in a more affordable city that I actually need to go down on my square footage. This is the opposite trend that we saw in COVID, where everybody was buying more square footage, where money was a little bit more abundant, shall we say, a little bit meaning a lot more. Okay, and I'll just go get more square footage because I want the space, and what the heck? But why not go up to a $3,000 mortgage payment? I can get a $900,000 home. Doesn't matter. I'll go get more square footage. Okay. So now there's also markets where the opposite is true. Okay. So there's some, since hitting bottom in October, there's a home size for a $3,000 monthly payment has actually seen a big increase in these 4 markets. So Salt Lake City, Utah, people are actually buying more. 365 square feet. Minneapolis, 357. Memphis, 346. Denver, Colorado, 340. Okay, interesting that they're buying more square footage. Maybe those markets, and correct me, if you're in one of that market, maybe those markets have more inventory, so it's actually eased up a little bit for buyers, and they can go get a bigger house. That might be true. I think certainly, some of these Western markets, and a couple of those we've seen more inventory. Another interesting nugget here: home for sale searches on Google. I love updating this one. While down 23% compared to a year ago, we went up roughly 38% from the low in November during the week ending February 4th. So if you need any more data that the spring is going to be likely our most active time frame in the market here in 2023, there you go. We're up 38% from the low in November in consumers searching on Google homes for sale. So if you're an agent, do you think you should have some SEO around homes for sale? Should you be putting out some content around that search criteria in Google? Should you be running an ad in your local market? Because I believe every smart agent right now is going to take advantage of now to May, now to say the end of May, beginning of June, as being the most active moment in the market. It might not be anything like we've seen activity-wise the last couple of years, but I'm a lot more bullish for real estate agents having just activity in these next few months than I am later on in the year. Okay. There's a lot more in here talking about what excellent credit can do for a home buyer. This is another good piece of content. If you've got excellent credit, what can that do for you and for your savings and for your affordability? You can read about it more in the link below. All of our sources will be available for you in the daily download link. A reminder, tomorrow I'll be doing this live from Orlando as we get prepared for our 3-hour Chat GPT workshop. Myself and Chris Smith, I'll be keeping him organized, keeping him on pace as we do this Chat GPT real estate workshop. It's tomorrow 10 to 1. If you sign up with the BAM offer, which is down below, you get $30 off the ticket, $99 ticket. You get it for $69. You'll be able to have access to this workshop if you can't make the whole thing. Everything you need to know about Chat GPT. You've been hearing a lot about it. How do you actually use it in your business? We're going to go deep for 3 hours and pick the whole thing apart. We also have a free 38-page AI tools for real estate agents ebook that covers all things AI tools. You can get that for free as well if you're interested. 10-year, where are we at up to the minute on the 10-year yield? Well, we're up again at this moment. We'll see what it does for the rest of the day. But we're at 3.762. Okay, so we're continuing to inch closer to Logan's top end at 4.25. We're still, far away ways from that, but we're also much further than we are from his low mark. Okay, and so we're sitting here at 3.762, inching up just like we did yesterday when we had this, when we had the hot sheet. And what happened yesterday? We did see this 30-year fixed rate go up once again. Okay, so yesterday we were at 6.62 on the 30-year fixed, and you can see here for the last week we have been in this 6.5 range, and 6.62. All indications are pointing towards another day of being somewhere around that range, maybe even a little bit higher. Okay, hope you'll consider joining me on the ChatGPT workshop tomorrow. The offering is down below for you to get that BAM pricing. And we've got a action-packed week, so I will be fresh and ready to go after my long drive tonight up to Orlando to deliver this hot sheet and all the information you need in a 24-hour look back on housing tomorrow at 9:30 Eastern. Can't wait to join you there. And until then, toodaloo.